Good afternoon. My name is Mickey Fulp. I'm the Mercenary Geologist. You can find my website at mercenarygeologist.com, and you can email me at contact@mercenarygeologist.com. As a disclaimer, I must say I'm not a certified financial analyst or a professional qualified to offer investment advice. Nothing in this presentation can be construed as recommendation or an offer or solicitation to buy or sell stock. Today we're going to talk about the Yukon area plays and separating the very few contenders in this space from the very many pretenders. If you're familiar with my work, you know that I have 4 key criteria in evaluating junior resource stocks for speculation. And notice I said speculation, I did not say investment. An investment is something that you expect a return on a regular basis, and certainly that is not what we have in the junior resource sector. My 4 key criteria are share structure, people, projects, and finally undervalued with respect to its peers. So being a field geologist, 30 years plus in the field as a practicing exploration or economic geologist, if you will, I have the ability to look at projects and make a decision quite quickly. So I generally look at a company's project first when I am evaluating it for speculation. I insist on a priority target, and that can be a flagship property which will have a good chance of becoming a producing and a profitable mine, or occasionally a prospect generator. And if you read and are familiar with my writings, you know what a prospect generator does. A junior has a time life. Generally, the average junior is going to be around in its present form on the order of, say, 5 to 7, perhaps 8 years. At that point, they generally become too diluted to be of interest anymore. So when I'm looking at a prospect or a project, I want to make sure that it can be developed, say something within the half-life of the average junior, so 3 to 4 years. And that very much depends on the commodity. I'm very particular about the commodities that juniors are exploring or developing. My current focus is on gold deposits, copper oxide deposits, uranium deposits, and rare earth elements. And within that context, we should also look at the deposit type and the potential metal content. So, for instance, in gold space, I am very much interested in sediment-hosted gold, so-called Carlin-type gold deposits, or epithermal deposits that can be mined in an open pit situation, which means they can be developed and processed without counterparty risk and also in a short time frame. And also, a project's very dependent on its location and the geopolitical environment with which it is, where it's located. Let's go on to share structure net. The key criteria in share structure are the number of shares outstanding and the number of shares fully diluted. I also look at the share price, the highs and lows within a 52-week period, a 30-day period, and a daily high-low to get an idea about when it might be time to buy a particular stock I'm interested in. One of the Achilles heels, if you will, about junior resource companies is the lack of a liquidity. They are often very thinly traded, and so liquidity is a very important part of the equation too, especially when you go to sell. If there's not a demand for your stock, then you're going to have a very hard time in selling it. And finally, I'm very particular about any sort of litigation. I basically will not touch a stock that has any sort of legal issue, pending legal issue. When we're looking at share structure, we want to look at the insider's family and friends holdings, the so-called tightly held portion of the stock, which is the real base for the company and gives it a very solid foundation from which to operate. Also want to look at institutional holdings. Institutional holdings can be both good and bad. For instance, if a particular institution controls 10 or 20% of the stock, then the management of that stock and therefore the shareholders are beholden to the will and of that particular institution, and that may not be in the best interest of other shareholders. And we also want to look at the public stock float, because that is where liquidity comes in with a retail lay investor, people like you and me who are generally not committed long-term investors of a stock, but looking for trades and profits. We also want to look at warrants and options, whether they are in the money or out of the money. They can affect the short-term or even the medium-term price of the stock, and in conjunction with that we need to look at the expiry dates and to know when those options and warrants will be exercised. In addition, for share structure, we want to look at the working capital, the cash and equities, and the burn rate, and that will include G&A and exploration, because that gives you an idea of when the company needs to go to the market the next time to finance its operations, because all juniors basically finance through increasing the equity position of the company and therefore diluting current shareholders. Most junior exploration companies do not have long-term debt, but that's something you also want to look at. And short-term debt is very important. That tells you if the company is currently paying their bills, and if they aren't, that raises a red flag right away. And then you also want to look at recent financings and see what's proposed, what's amended, what's been closed, and especially if it's been canceled or amended, tells you there may be something wrong with the company and the financing is not going very well. A recent private placement and the warrants issue will tend to put a cap on the share price, at least in the short term, and certainly within the 4-month hold period right after that. If the stock's gone up, you're going to have people taking profits, going to depress the price of the stock. Finally, in my three key criteria that form the basis for a decision on a company, we want to look at the people. The management team, which would consist of the CEO and the president, the CFO, and the board of directors. And we want to make sure that the CEO, I prefer a technical person for the CEO, either a geologist or an engineer, because they really understand the business of finding, developing, and putting a mine in production. Within that, we will also have a technical team, which will consist of a chief operating officer, a chief geologist, a VP exploration. Well, what's the difference? Well, a chief geologist is the guy that manages the technical side of the exploration program, while a VP exploration is usually someone who is a manager, lets drill contracts, manages and proposes budgets, etc. There will also be, if it's an advanced project, mining and metallurgical engineers, and then a staff of senior and junior geologists and engineers. Oftentimes the best companies will have an advisory board, and that will be key consultants on both the technical and the financial aspects of the business. When we look at the people, we want to look at their educational and professional backgrounds and their bios, their experience in the junior resource sector, not just their experience in junior capital markets and venture capital, but I insist that they have previous experience in the junior resource sector, and they must have success in that arena. A company that, or a person, let me say, that has been bankrupt or been associated with 3 bankrupt companies, I do not consider an entrepreneur or a good venture capitalist. We also want to look at the compensation. Are they overcompensated? There is certainly within the junior resource sector on the Toronto Stock Exchange, people that have found a way to make a living on the public company dole. So you want to look at their salaries, and not only that, but their management fees and options and bonuses, the whole compensation package. If that is out of sort, out of whack, much higher than the, say, the industry average for a junior resource company, that raises a red flag right away. Finally, I want to see technical expertise within the board of directors. My ideal board of directors composed of geologists and engineers with 1 financier, 1 lawyer, and 1 accountant. If you see a board of directors headed by a bunch of lawyers and ex-brokers and accountants, that raises a red flag right away, because they're not going to have the technical expertise to advance a project. And finally, let's talk about insider selling. And that's not only illegal insider selling, but what I would call insider trading. When you see rampant and repeated insider trading by the people associated with management at the top of a company, that raises a real big red flag for me, and it is, in my opinion, the bane of the junior resource sector. I will not touch companies that have rampant insider selling. So, in my process of evaluating a junior resource company, let's say this. There's 1,750 of these companies on the Toronto and Venture Exchange. 50% of those will fail my criteria for flagship project. 25% will fail on the share structure. An additional 15% will fail on the management or technical teams, and finally 5% will fail on website presentation. If they do not have a good website and complete website presentation, including technical information for the geologists and analysts and the brokers and people that are professionals to evaluate the company, that's a fail for me. So you add all that up, and 95% of the companies on the Toronto and Venture exchanges will fail my key criteria for share structure, people, and projects. So within that, so we've taken 95% fail, and as a final test, my final test is the company has to be undervalued when compared to its peer. Now, there are very easy criteria. There's a number of brokerage houses and banks and analysts who publish peer valuations for a company, generally on the amount of metal in the exploration business in the ground. If you've noticed, if you look at, and I will dare you to find me an active junior, not a dormant junior, but an active junior who share price from its 52-week high to its 52-week, any given 52-week period, high to low, is not at least a double. So that gives us our N right now. The undervalue is very dependent on the timing of the company. What was undervalued 2 years ago is may or may not be undervalued today. If I pick a stock because it's undervalued, if I'm doing my work right, it will not be an undervalued stock within a month or 6 months or 12 months. And 12 months is kind of my deadline for a stock to double. The key in this is you want to buy at low volumes. And if you notice, low volumes generally correlate with low prices, and sell at high volumes. So within any 250-week period, given a junior will double, if you buy at low volume and sell at high volume, you're going to double your money. Simple as that. And I call this the power of two, my investing philosophy. And that basically is the stock price must double in 12 months or less, otherwise I will not speculate in the stock. When it doubles, I sell half of my position. That gives me a cost basis of 0, and I still have half of my position left. So then I'm playing with someone else's money, or I'm playing with house money, or I even may be playing with your money by that time. And so we take that capital, we preserved our capital, we reinvest in another undervalued stock. I have open orders to sell 1/2 of the double on the 29 stocks I currently hold. We program sell at intervals on the uptick, so we're continually taking profits off the table from our 0 cash basis, cost basis stock. And we set profit stops. And I don't call these stop losses, but they are essentially stops for bear dips in the market, or a company does not perform after it's achieved its double, or the market is bad, or for whatever reason. We set stops on the downtick, so we are continually taking profits. It's a program sell sort of scenario. We reinvest time and time again. We preserve capital, and we gain half positions in more and more stocks. If you do this 5 times, you still have your capital preserved, and you have half positions in 5 stocks that you have 0 cost basis, and you're ready to do it a 6th time. It's a very simple way. This is an infallible way to make money in the junior resource sector, assuming that you make good stock picks to begin. So now let's switch to area plays, and we're going to talk about the Yukon area play. And as a review, I want to go over the last 6 area plays that I remember since I became involved in the junior resource sector. The first one was Hemlo, Ontario. The discovery was made at Hemlo in 1983. There were mines being built by 1984, but they were consolidated as one deposit. So out of that big area play, and if you've been around for that many years as I have, you know what a big area play that was. That was a grassroots discovery, 15 meters from the Trans-Canada Highway. It led to dozens and perhaps even 100 juniors flooding into the northern Ontario area around Marathon, Ontario, and out of all of that, the original discovery was the only mine ever developed, the only big mine developed in that area. Same at Eskay Creek, same guy, Murray Pesum, was responsible for that. Eskay Creek was discovered, the big discovery was made on the 109th hole. That rush, which made many of my peers that were involved in it, many geologists became rich on that one. That resulted in one mine. The next one was the diamonds in the Northwest Territories. One mine originally discovered by Diavik, or by Chuck Fipke's syndicate, became the Diavik mine, and now we have 3 mines in the area, 3 big diamond mines, but it took 20 years to develop those 3 diamond mines. We had 2 right away. But that whole diamond scenario, which moved the market in the early 90s, only resulted in 3 mines. The next one, 2 years later, was Voisey's Bay. That resulted in 1 mine. People flooded to Labrador looking for the next Voisey Bay. We're now, 18 years past that discovery. There is still only 1 nickel mine in the entire province of Labrador. The next one was Pierina in Peru, Arequipa Resources, another of David Lowell's successes. That resulted in 2 mines. The second mine, Alto Chicama, was discovered by Barrick 7 years after the 6 years after the discovery of Pierina. So within that very big area of northern Peru, there have been 2 windfall profit mines, or giant mines, developed out of that. The latest area play was La Bodega in Colombia. That happened a couple of years ago. We still don't have a mine. As I look at everything that's gone on in Colombia, I only see one windfall profit mine, and that will be, likely be Ventana Gold's La Bodega deposit. So the point to take here is these new area plays do not result in very many mines. Yukon area plays. So my friend Glenn Jones, and you will know him at the conferences, he's the guy that has all the free land maps in Tierra Resource Intelligence, told me yesterday there are 140 TSX and venture companies with plays in the Yukon. 95% of those will fail my key criteria right off the bat. That means that 6 to 8 companies of 140 will pass my criteria for consideration on speculation. But how many of those are undervalued right now? Well, it's a Yukon area play. I would say very, very few. And if we look at the history of area plays for the last nearly 30 years since Hemlo, there will be 1 to 3 giant or windfall profit mines discovered and developed. So that gives you an idea of the odds we're faced with. Okay, here's a map provided by Mike Berkey of the Yukon Geological Survey, soon to be in the private sector again. Congratulations, Mike. But I want to show you the areas that are of importance in the Yukon. People call it the Yukon area play. It's actually Yukon area plays. So within this we have the White Gold District around Dawson and to the south. I would include that within that the entire Dawson range, and that is in the west central BC where you see all those yellow and orange dots concentrated. On the northeast part of that trend is the old Tombstone intrusive suite deposits such as Brewery Creek and Dublin Gulch. They have been revamped, but those are not new discoveries. They are old projects that failed in the past, and now with a higher price of gold, perhaps they will be discovered. Immediately to the east of that, you see a couple of dots out there going into east central Yukon, and that would be the Rao trend of attack resources, and that is certainly a new grassroots discovery. And then the rest of that kind of in the south central and southeast parts of the Yukon are just recycled projects from previous booms, including the lead zinc deposits, the Selwyn Basin, and the VMSs discovered in the 80s and 90s in southeastern BC. So those are just recycled projects too. So basically we've got a couple of areas that are hot with new discoveries. The risk in the Yukon area plays are significant, and basically they have to do with location. They are remote. There is little to no infrastructure throughout most of the Yukon. For instance, the Osiris project of attack resources is 100 kilometers from the nearest road. We also have, because it's in the Arctic region, we have climate issues and a very much seasonality of work. You can basically work up there for 4 or 5 months of the year, and then you're snowed out. This leads to very high cost exploration, so the burn rates of these companies are going to be extreme. It also results in unsteady news flow, and there will be a dearth of news over the winter here. As the final drill results from the summer and fall are released, then field work will not start up again for the most part until perhaps May, so we're going to see a dearth of news. Also the remoteness and the climate is going to lead to very high CapEx for development of these deposits and high operating costs. What makes a good mine? Well, we all know that we have this incredible boom and bust of commodity cycles. Now, I personally think we're in a secular bull market for commodities, but the timing, because of the cycles, the timing of development and production are key. You want to go in when, not at the top of the market, not when commodity prices are at their peak, but generally when they're low. By the time you develop your mine, you'll hopefully hit the next cycle. For a junior, you want relatively low capex, because otherwise your only exit strategy is sell to a bigger company, a major, and that means you have to have a major size deposit. So juniors have limited ability to raise capital, so you want relatively low capital expenditures on the project they're interested in. And finally, this is going to be a key in the Yukon. You need to be within the lowest quartile of operating costs, because that ensures your viability throughout the low prices of a commodity cycle. So let's look at a couple of companies here, and I'm going to review a couple of the better companies, and you're going to hear lots of talk about these companies. They're well run, and they have legitimate projects. So this is Kaminak. You see the great rise, the discovery at the coffee deposit in August, the spike up, and then the general trend down on decreasing volumes. I've talked to technical analysis guys. I've been watching Kaminak. As the winter progresses, we are going to see, I think, lower prices for Kaminak. My technical analysis guy, Gary Tanashian. Gary, I would suggest you look into his newsletter called Notes from the Rabbit Hole. He's a TA guy, and he is telling me that $2.40 is his target price to buy Kaminak. Hasn't gotten there yet, but if you look at the trend, you have a so-called flag there between the high trend, low trend, and $2.40 might be a place to take a look at Kaminak. The next one is Attack, and you see it rolling along there. This is a well-run, very long-lived junior by people who have worked in the Yukon for a long period of time. We see the spike up with a discovery at Rao, and the high share price of $9 in mid-November, and a steeply plummeting price since then. It's been treading water since the first couple of weeks of 2011. Gary tells me that he's looking at a target price of about $4.50. With the dearth of news in the Yukon, perhaps these stocks will reach his target prices. But I just want to tell you that TAC was 90 million shares outstanding, and a price around $6 right now, has a market cap of $540 million on nothing but a couple of drill holes. So this is pure speculation, folks. There is a lot of risk. Finally, I'll talk about my favorite company in the Yukon right now. My clicker is fairly slow here, so bear with me. And that's Tarsus Resources. And Tarsus, as you can see, has had quite a run-up. It's changed its tactics from over the last year or so. It's become a prospect generator in the Yukon. As you very well know, I love the prospect generator model. We see a significant rise in stock price. It got as high as actually touched 71 cents on intraday high not shown in the chart. This is closing prices, and it has drifted down. I would suggest that Tarsus could be a buying opportunity at its current prices. It is very tightly held stock with 15 million shares out. Do the math, at a 50-cent price right now, has a market cap of $7.5 million. Compare that with some of the high flyers in the Yukon right now. The other thing it has going for it is a sister company of another very successful prospect generator that I covered in July at 90 cents. Has been as high as $5.46. That's Almaden. So Tarsus has the same management, the same major shareholders of Almaden. That is my top pick in the Yukon. When you're picking junior resource companies, you must do your own due diligence. I want to tell you that your own personal research is the most important thing that you'll ever do when you speculate. I like to say a day without learning is a day wasted. I have a company evaluation template that I would be willing to offer any of my free email subscribers. Become a subscriber if you are not already one. Everything I do is free on the internet. I will send you my company evaluation template. Buena suerte, inversionistas, which means in Spanish, good luck, investors. I run a free email subscriber service. I do lots of radio, lots of TV, and I write a couple of times a month. My newsletter is called Monday Morning Musings from Mickey the Mercenary Geologist. Go to my website, sign up, request a free evaluation template. Most of you see me in a monkey suit all the time, but I am a field geologist. This is a picture of the Tutagon in northern BC, where I made an outcropping gold discovery in 2006. And finally, I want to give credit to a man who was one of my very good friends. I knew Ricardo Presnell from my work at Kennecott starting in 1988. I would dare say that Ricardo, in his exploration for Kennecott in the Yukon from 1996 to 1999, this is the man who figured out that deep auger soil sampling was the way to go, and everything that's come out of the Yukon since then, I think Ricardo kick-started it between 1999 or 1996 and 1999. Thank you very much for your time. I will be available for questions, not after my talk, after this talk, but sometime over the course of 2 days. Certainly in my booth, we will set aside some time for general Q&A from anyone who desires more from the Mercenary Geologist. Thank you. Goodbye.